Good afternoon, and thank you for joining today's session. My name is John Powell, and I'm a senior banker for NAB's professional services team here in WA. Before we begin, I'd like to acknowledge the traditional owners of the country on which we meet today. I would like to acknowledge the Whadjuk people of the Noongar Nation as traditional custodians of the land on which I stand. I'd like to acknowledge all elders, past and present, as well as future leaders who continue their role as proud custodians of the country they belong to. I'd also like to acknowledge the Indigenous customers and colleagues who join us today. Today we'll be hearing from Gareth Spence, Director of Economics, and Mark Browning, Head of NAB Valuations. There will be an opportunity for questions, and I encourage you to use the Q&A function throughout the session. Gareth is a member of NAB's Group Economics, a leading team of economists who provide accurate, timely, and relevant updates on domestic, international, and industrial economic trends. Mark has been Head of Valuations and Property Advisory at NAB for the last 7 years. His responsibilities include residential, commercial, and rural valuations, as well as business valuations, panel management, and operations. Gentlemen, thank you for your time today. Our audience is looking forward to your valuable insights. I'd like to now pass to you, Gareth.
Thanks for the introduction, John. I'll just bring up my slides. All right. Thanks, everyone, for having me along today. I guess in the time we have available, I think for me, really what I'd like to do is sort of run you through some of the big forces that are kind of playing out through the Australian economy and how they are flowing through to the property market, and maybe some of how those property market dynamics are flowing back through into the property market, via activity and inflation. But before I do, I guess I'd like to just set a bit of a context in a global sense, given Australia is a small open economy, and it doesn't need to remind anybody out there of the importance of global developments for us. So, like us, rates have risen very sharply across the advanced economies and are now at their highest level in around a decade. In response to the very big inflation shock that's played out globally following the pandemic. The good news is inflation does look to have peaked globally, and it has eased notably in a headline sense, though there is some deviation across the underlying measures. So alongside that, we basically think that rates are at or near their peak in most advanced economies, and growth has certainly slowed globally. We've avoided major downturns in most areas to date, and the labour market has remained quite resilient despite that very sharp slowing in growth. So a bit of context for Australia, where rates have also risen very sharply. We're up about 400 basis points over the past year, 12 rate hikes at the highest level since around 2012. For the RBA, alongside a very high rate of inflation like we've seen globally. So what are we first sort of looking at is kind of how is this flowing through to the household sector? And the way we think of this as economists is basically the impact on disposable income and household budgets as interest burdens kind of weigh on after tax and after interest income, and prices reduce the real purchasing power of households. So on the left-hand side, you can kind of see a couple of things there. Apologies, a bit of a busy graph, but really something to focus on is the real disposable income growth line. So this is income after tax, after interest payments, and after the impact of prices. And we can see that that's down around 3.8% over the past year. It's quite unusual for it to actually fall, but maybe not in the context of the very sharp price increases we've seen over the last year. So you can see in the lighter blue bars that prices have subtracted around 6 percentage points of growth from household income. The interest burden, so the green bars, or interest payable, is obviously rising as rates have risen. So consumer and housing debt repayments are weighing And you can see that the tax burden has also increased as bracket creep has increased a little bit as we see some growth in nominal wages. Some positive sort of offsets, I think, are quite interesting at the moment as well. You can see that the yellow bars back in history around 2020 certainly highlight just the sheer support the other net income received from government payments. That has obviously waned a little bit as we've passed through the pandemic. But what has taken over is really quite strong growth in labour income. So that's due to both a very strong rise in employment as well as that lift in nominal income or nominal wage growth that we've seen. Another way of looking at this after around 4% of rate hikes is how is that flowing through the cash flow channel and the impact on the household mortgage burden. We can see here that, you know, both scheduled and interest payments have now risen to around 15% of household disposable income. It's risen quite sharply in recent quarters as those rate hikes have all sort of really started to pass through the economy. It's now around the highest it's been since 2012, where rates were a little bit higher. So certainly starting to see some impact at the aggregate level of both higher rates and inflation. Something we do in our team is we run a quarterly consumer sentiment survey. A large component of that is our consumer stress index. So effectively asking consumers across 4 measures what is kind of weighing on them. Obviously, cost of living is taking quite a significant prominence at this point. Maybe unsurprisingly, without being flippant, is to sort of highlight that the stress is certainly showing up, and maybe in the areas you would expect. So, you know, the younger age groups, those on lower incomes, larger households with higher cost structures, the unemployed, and renters. That said, given the broad-based nature and the strength of inflation, as well as the rapid pace of rate increases, we actually have seen an increase in stress across most cohorts over the past year. This has also certainly been reflected in aggregate measures of consumer sentiment. So the Westpac Melbourne Institute survey ticked up last month. That said, it remains quite weak around its GFC and pandemic lows, and it's kind of the longest period it's tracked at such a low level in the history of the series. So certainly coming through in a sentiment sense as things progress. On the other side of that, the business confidence measure that we capture through our monthly business survey, it's kind of tracked sideways for the better part of a year. It's certainly eased from the strength we saw in early 2022. It's fallen to a below average level, but it's still kind of well above those troughs we saw in the GFC or even in the pandemic. So some contrast between consumers and business at this point. How is this flowing through to actual spending and actual activity in the economy? Well, obviously consumer spending is very important for us at around 60% of GDP. Consumption growth has slowed, rising just 4.4% in each of the last 2 quarters, kind of well off the growth rates we saw as we rebounded out of COVID over the last couple of years. Interestingly, how are the adjustments playing out at the aggregate level? Again, maybe as expected and maybe not as severely as expected. So discretionary consumption has fallen for 3 consecutive quarters, hasn't fallen back to its level in 2019, reflecting just how strong spending had been as we rebounded out of the pandemic. Essential spending continues to rise at a slightly slower rate. And I guess still very much watching the balance between goods and services spending. So as we're all well aware, as we locked down during the pandemic, we couldn't spend much on services. We couldn't travel, eating out, all that kind of thing. Goods spending, you know, in Australia and globally picked up very strongly. And so kind of an unwind as the pandemic fades is that rebalancing between goods and services. So goods spending has certainly slowed, but it looks to have stabilized in recent quarters. And services spending, you know, has recovered its previous level, and has also slowed as we've progressed through the adjustments. So good news is it's not completely falling away despite those pressures. Our internal consumption data, which is nominal, tells us that spending has held up into Q3. The flip side of that is the savings rate. So as household incomes have been pressured, households have not only adjusted their growth in spending, they've also pulled back somewhat on savings. So you can see there that the net savings rate fell again in Q2 to its lowest level since pre-GFC, from those very high levels it reached during the pandemic as incomes were supported but spending was curtailed. So a bit of a balance there, maybe somewhat to be expected. Savings rate is still positive. Households are adjusting in aggregate as they are at the individual level. The business survey we run on a monthly basis is quite a bit more positive than those measures of sentiment and business confidence. Business conditions, which is the question where we go out and we ask businesses, how are your actual trading conditions, your profitability and your employment levels on a monthly basis, has certainly fallen back, but it's fallen back from a very high level and in fact actually remains well above average. So quite a contrast to the forward-looking sentiment measures. And indeed, when we look across industries in the survey, conditions are actually quite robust, including in the retail and rec and personal sector, where we think some of that consumer rebalance or pullback might eventually start to show. So at present, very much a story of an adjustment phase at the individual level, certainly some pockets of stress, but in aggregate, the economy has actually remained quite resilient, and that's certainly come through the business survey. And I think, a key thing that we're sort of learning as we go, but has been evident for a little while now, is just how strong population growth is and how much of a key support that has been for the economy. So the data are generally lagged, but over the year to March, population growth Australia-wide picked up to around 2.2%. That's its strongest rate since late 2008. We typically grow at about 1.5 to 1.6%, and about 2/3 of that is due to international migration. As borders opened, we've rebounded very strongly and much more strongly than anyone would have expected in a population sense. After slowing to a 100-year low of just 0.2% in mid-2021. Over the year to March, we've seen around 450,000 migrants enter the country. And higher frequency labour force data actually shows us that population growth has remained strong well into Q3 of 2023. So very much the same story for some of the states we're looking at today. You can see there on the left that WA population growth has picked up to its strongest rate since the late 2000s. 2.8% has accelerated into 3%, the 3% range based on our higher frequency data. You can see there the story is very much a rebound in overseas migration, but also for WA, in contrast to pre-pandemic, a shift to inward interstate migration, whereas the state had been seeing outflows prior to the pandemic. So quite well supported and a strong pickup in population growth for WA. Bit of a similar effect for South Australia, actually. So you can see migration has picked up quite strongly there, 25,000 migrants over the year to March, and population growth rising to 1.6%, which is quite a strong rate for that state. For for NT, obviously state-specific factors dominate a little bit more given its size. But again, you can see there just the impact the rebound in overseas migration has had. However, unlike the other two states, in contrast to resuming the trend pre-pandemic, we can see that the outflow to other states has kind of resumed and really weighed on population growth there. So it has accelerated a little bit as borders have reopened, but hasn't strengthened as much as other states. So, in addition, I guess, to the overall aggregate impact and demand that we see from population growth that's coming through the business survey, obviously a big impact on the housing market. I'll leave it to Mark to take you through property prices and rents and the state dynamics in a bit more detail, but largely I'd just like to reflect on just how important or how significant that strength in population growth has been. So borrowing power is down by about 30% for the average borrower, more depending on who you are. We did see some adjustment in house prices as rates began to lift off, but actually as they've kind of leveled off, and maybe even a little before that, we've seen a very strong rebound. So while property prices across the capitals had fallen by about now 9%, they've actually almost entirely or nearly entirely rebounded now and are growing quite strongly. and particularly evident in those states where where the demand from migration is strongest. So you can see here that, initially Sydney kind of picked up, but more recently, actually, Adelaide, Brisbane, and Perth have strengthened quite a bit as well. Again, where does migration show up in the property market? Well, we know that most migrants rent for their first couple of years. With that strong growth, we've certainly seen vacancy rates, gets a few headlines, in the major capitals actually fall to very low levels. Those very low levels of vacancy rates have seen rents bid up, tracking at very strong rates across the capitals. It has eased slightly in some areas recently, but generally remains quite high. The flip side of that has also been maybe a little bit of an easing in supply. So right as demand has come back quite strongly in housing, the number of completions nationally has fallen relatively sharply. So from around 200,000 new dwellings a year pre-pandemic, it's fallen back to around 175,000 over the last couple of years. And you can see there very much a pattern that is mirrored indeed in WA, the NT, South Australia, maybe a little bit more optimistically or encouragingly has actually strengthened a little bit and is at a relatively high level. So the supply side overall not helping that demand with the imbalance. And I guess why or what are some of the driving factors that we're looking at in kind of the issues or the supply side of the market is just the sheer impact on construction prices, the disruption we saw in the pandemic. So our quarterly residential property survey, which will be released next week, includes a question on the barriers to new housing development. Quite clearly coming through that survey, and the chart on the right is just the significance of construction costs and rising interest rates as a barrier. The positive news is that maybe it has eased very slightly across both of those measures between Q2 and Q3, but they do remain high. And I guess the left side of the left-hand chart kind of shows you that, encouragingly, inflation in construction input prices has certainly eased, and at best they look to be leveling off. But we're yet to really see a major correction in those prices. So steel and timber, for example, have eased, but they do remain high and obviously still weighing very much on the construction side. Now, it's a little bit of a quirk, and what's quite odd about this is that while completions have slowed, the pipeline of work, so, dwellings under construction or about to be commenced, are actually very high. So the pipeline has risen to about 270,000 as we saw that support for approvals through the pandemic, but construction was slowed. So while commencements, have improved slightly recently and completions have fallen, a very large pipeline will look to support construction, at least in the near term. But with rising rates and those construction costs and just the elevated uncertainty, building approvals have certainly trended down. So the new inflow of work into that pipeline is certainly slowed. It's around its lowest level since 2012. And once things all wash out, we're kind of like tracking at about a completion rate of 140 to 150,000 dwellings a year, which is quite a bit short of the demand we're seeing from population growth. So what's the net impact of that? Well, another aspect of the cost of living, which we're looking at. So PropTrack have handily constructed us a nice new set of affordability measures where effectively they track the share of sales that the median income could afford by spending 25% of their gross income on housing in a year. You can see that as rates have risen quite sharply and prices have sort of stayed high or even increased, affordability has decreased quite sharply. You can see that South Australia is the least affordable across the three states we're talking about in this session. It's broadly in line with the Australian average. Slightly more affordable in WA and the NT, but also quite a deterioration over the last year or so. Turning back to inflation a little bit more broadly, like the global story, it is encouraging. So inflation does appear to have peaked in Australia. Those supply chain pressures and easing in global inflation, as well as maybe some leveling and correction in commodity prices, is flowing through. That very much comes through our tradables inflation. So this is typically goods imports that we buy from overseas. We are seeing a bit of a pullback in inflation there. It is still high, but it is coming off, and you can see that across the tradables and the goods measures. What we're really looking at as economists and policymakers in terms of rates and the economy more broadly is what happens to the non-tradable components. So these are things we think of as typically having, a much larger domestic component of inflation. So much higher labor cost. They're non-tradable. They're things like, restaurants, cafe, takeaway meals, haircuts, other services. Typically, you can see there that remains high. It is easing slightly. But there are some questions about just how quickly that'll ease when we consider things like rents being measured as part of that inflation component, and just how tight labor market is feeding through to stronger wage growth. So on the labor market, despite that slowing in growth we've seen more broadly, it has remained quite resilient, which has been the case globally. The unemployment rate is tracked at around a 50-year low for almost a year at about 3.5%. It's edged up to 3.7% over recent months, but really where that's come from is just the sheer strength in population growth. Job vacancies and labour demand look quite strong, and imply ongoing strength in employment in the near term. We can see that that's eased a little bit over recent quarters, probably more driven by an easing in sort of labour supply constraints as migration has returned, rather than a complete fallback in activity for now. But I guess one part of this, and something we're watching quite carefully, is just what happens to wage growth as a result. So for now, it's certainly accelerated. It's up to around 3.6 in annual terms. That's relatively high compared to pre-pandemic, but actually historically is not excessive, and probably something that's not incompatible with inflation returning back to target. So what do we think that means for rates? Well, we still think the RBA will do another rate increase at the margin, and we think it'll happen next month following the release of the Q3 CPI data, where the RBA will be surprised slightly to the upside just on some of the services strength, as higher wages sort of flow through and petrol prices again push the CPI up. But really the question is, now that we're in restrictive territory, so the rates are slowing the economy, how long do we hold at that high level? We've penciled in a relatively extended period of unchanged rates until around mid next year. And as inflation, eventually returns back to the target band and growth slows, the RBA will begin to cut back towards neutral or something around 3%. So how do we think that all plays out? I don't want to be too negative. I think it's important to realise here there certainly will be a period of below trend GDP growth, but we don't see a big recession. Basically growth will slow, and the key dynamic will be household consumption given its size. But some of the other components will also matter. So the activity side of dwellings and building construction will matter, as well as business investments as the consumer slows, but capacity utilisation remains quite high in the sector. That slowing in growth certainly sees some easing in labour demand growth, and amidst very strong population growth, we do expect the unemployment rate to rise. It is from a very low level, and it is to a level that's probably a little bit below where we were pre-pandemic. So, we don't see the major scarring or fallout that we might have once feared in a downturn. The employment side of that is actually important to remember. We don't see sort of a large scale job shedding, that rather this pickup in unemployment is just a slowing of labour demand rather than companies downsizing employment. On inflation, as pressures in the labour market ease and those global factors continue to ease as well and flow through, we expect inflation to continue to moderate. It's looking like it will be quite easy for inflation to fall back to the low 4% or high 3% range, depending on what's going on. And then from there, it will be interesting, right? It's quite a challenge, and it's a little bit further out, but just how quickly we go from that high threes back into the band will be quite important. On our forecast, we have inflation at the top of the band by the end of next year and kind of falling back into the top of that range by mid-2025, at least giving the RBA some scope to begin easing rates. So I might leave it there and allow Mark to take you through some more detailed information on the property markets in each state.
Thanks, Gareth, and thanks again for the invitation. Great to have the opportunity to share with you. Just to give you a sense as to the areas we'll be covering today, we will cover residential markets, both capital city for each of the three capitals and the rest of the state, and we'll then cover some commercial property and some rent roll insights as well. In brief, just to round out the picture. Now, we know property is super important, not only for the economy, as Gareth's been talking about, but for household wealth, and important for the sector and the inputs more broadly. So with housing sitting at 10.1 trillion and commercial real estate at 1.3, these are major drivers in our economy, and no wonder that it's important that we continue to focus on this topic, and property more broadly remains a key interest for those barbecue conversations, as you were saying earlier, John. So this is a glimpse across the country of houses and units, both for the quarter and for the annual growth. And today we're very focused on Adelaide, Perth and Darwin at a capital city level, which are the highlighted ones. And you can see each of those showing in Adelaide and Perth the strong levels of growth that has continued to occur in those markets, and some softer conditions in Darwin, which more recently for the quarter have started to show some more positive trends as well. Whilst we're continuing to be national, this picks up for the last quarter what's been occurring across each of capital cities and regional markets, and you can see there, Perth 3.6% growth for the quarter. Adelaide, the strongest of the capitals, at 4.3%, and Darwin at 1.3% for the quarter. And regional WA 1.7, regional SA continue to show strength out at 2.8, strongest regional market in the country. And of course, the regional NT still also in growth, but at 0.9% as well. And on the chart on the right gives you a time series for the last 10 years of how capital cities versus the regions have actually tracked on a rolling quarterly basis, just to orientate you around how those markets have tended to operate over time as well. Whilst we're remaining at a national level, this gives you the quartiles of the market. So the 25%, which is the red colour, the red columns, shows you the most affordable quartile of properties in a particular market. The black bar is the most expensive quartiles. And across Adelaide, Perth and Darwin, it is the most affordable quartiles that have had the strongest growth over the last quarter, respectively at 4.9%, at 5% in Perth, and at 2.6% respectively, with the most expensive quartiles performing still with growth, but at a lower level of growth performance over the quarter, which just again highlights the challenges around affordability as well as supply options that we will touch on in a few moments' time. Talking of activity in the market, this picks up what's been happening from the numbers of sales in the market. And this is comparing the 12 months to the end of September with the prior period. Shows on first regard, it shows a significant softening in that level. And I just think it's important to remember back at that stage of 21 going into 22, we had, for the most part of that, record low levels of interest rates and high activity happening from a sales perspective. So not unexpected that, we've seen sales in Adelaide pull back 12.9, in Perth 1.6, and in Darwin by 7.2, and you can see the respective regional ones as well. And that is more a normalisation of those factors rather than a particular deterioration in the underlying market. And as you can see, happening right across the country as well. What I thought we might do now is start diving into the capital cities respectively, and we'll cover each of the three capitals as we go. First one we'll tackle is Perth. Perth's been a particularly strong market, really has avoided the trends of the East Coast with the easing in those market conditions as interest rates increased. It's been able to move on through that. And saw again rates, the property prices levels increased by another 1.3% last month, 3.6% over the quarter. It's now 8.8% higher than the last trough in the market, which was back in September 2022. What's so hard to find property in Perth, as anyone who's in the market would reflect, is simply because the listings are so far down. So what we're showing there is Perth listings compared to the same time last year are down 30, total listings that is, down 30.6%. If you look at compared to the 5-year average, it's down 44.5%. And even new listings, are still down 4.4% on last year and 4.9% on a 5-year average, just reflecting the appetite for property and one of the key drivers of why price growth has been occurring in the market. That's reflected on average days in market, as you can see there, middle of the page, down to 13 days on market, 21 days at this time last year. And vendor discount has diminished down into the 2s from 3.4% last year. And as Gareth was talking about, the annual growth in rents continuing to increase, so up 12.7% for houses and 16.2% for units. And that assumes you can find one because there's record low levels of vacancy that exists in the Perth market, and really a challenge to not only find houses to buy, but houses to rent as well, properties to rent and buy. Bottom of the page here reflects what has been occurring for the month, quarter, and annual picture for dwellings, which is a combination of houses and units, and that's the headline numbers that's often reported. Middle of the page is houses, and the far right of the page reflects what's been occurring for units. I think it's always helpful though to bring it to life with a graphic, and this gives you a picture here of the markets, and the deeper the blue, the stronger the price growth over the last quarter, and a couple of pinkish pieces shows some price easing occurring in those respective markets over the quarter. But again, predominantly shades of blue as you see what's happening in Perth, and that's not unexpected given those low levels of listing, the demand, and the price growth that has been occurring more broadly. If we move to seeing this in a tabular format, here represents the key regions, SA4 regions, and reflects the monthly price and quarterly price growth that's been occurring. For the month, it's the Southwest, and for the quarter, it's Mandurah that's experiencing the strongest growth. And on the right-hand side there, just a couple of remarks to share in and around rental value growth across those respective regions, time on market, number of selling days, in Perth Northwest, quickest there at 14 days, and the sales activity across the board that varies from 8 to 14.5% more broadly. That's in that same way. I thought it's good just to show those average, the number of sales across those key regions as well compared to the year prior. So this is reflecting that same trend that I'd shared with you at a Perth level. And then, of course, just to share some of those same insights from a regional WA perspective, again, reflecting the four SA4 regions in WA, and with Outback South reflecting the strongest level of price growth for the month, and Bunbury, of course, for the quarter, showing the strongest quarterly growth. Again, with reflections on the right-hand side there on dwelling growth, rental values and sales, selling days and selling activity across the regions of Perth and more specifically around WA, more broadly regional WA. If we return to Perth though, and just have a few remarks around commercial property in Perth, again, largely avoided lots of the easing that's been seen in some of the East Coast property sectors. Industrial property still being hotly sought after, and owner-occupier demand remains strong in Perth. And you'll see also the rise in rents that's evident over the last year across those respective regions, and new supply that is underway as well. So industrial remains an area of strength. Retail spending's remaining relatively strong, notwithstanding the wider economic factors that Gareth mentioned at an economy-wide level. There is some mild increase in rents depending on the subsector, and as many of you would have seen that reside in Perth, some new supply, also new precincts coming on, and some extensions of some of the centres as well coming to life as well. In the office market, we've seen East Coast office, Sydney predominantly, and overseas office markets feature heavily in media. That's the same challenges are not evident in Perth. We've still got positive net absorption on space, and the strong local performance of the economy has kept up demand more broadly. Not unexpectedly, we are still anticipating that the levels, the yields that are applicable for office will progressively ease as would be expected in a rising rate environment. But there's not actually major sales as yet during the last quarter to be able to evidence that in the local market, albeit some early reports of activity that is occurring. More broadly, the vendor and buyer standoff does mean that unless a property is being forced to transact, that activity level of office sales has really diminished. And then perhaps just to round out our time in the West, some reflections there on the rent rolls. Again, strong demand that is evident, and as you would expect, benefited. The rent roll multiples are benefiting also from, and total prices are also benefiting from the rise in rents, and as Gareth's already touched on, the net immigration into WA as well. So just rounding out to that picture, still an area of active interest and activity occurring in the market. If we move to Adelaide, some of the same themes are evident here. Largely, Adelaide's also been able to avoid the significant adjustment that was evident, particularly in the East Coast, Sydney or Melbourne property prices last month, setting the pace at 1.7% growth for the month, which was the strongest of any capital city. Nationally, 4.3% over the quarter, and dwelling values are now 6.3% higher than their prior from the trough in the market, which was back in March of this year. East Coast largely started the turnaround in around January of this year, so a couple of months later, but has been a stronger rate of growth as it's made up momentum on the way. Again, similar to the Perth slide, you can see at the bottom of the slide how that's transpired into dwellings for the month, quarter, and annual picture, and then houses and units on the far right. Listings are one of the key drivers, and lack of available supply continues to be a theme here in Adelaide as well. Reflected their total listings are 14% lower than the same time last year. In fact, they're 38% lower than the 5-year average as well. So again, reflecting how tight it is to find property, and being one of the key drivers of strength in property prices that is occurring here in Adelaide. New listings, there is some early signs there of some positivity if you're an agent looking for transactions, or if you're a potential buyer looking for options. New listings are up 4.7% on this time last year, but they're still off 8.6% over the 5 years. So new listing is something that's only come to market in the last 28 days. So one to watch, but still, as I said, well off from a total listings perspective, the longer term averages, and one of the key drivers of growth in the market. A little bit of tighter conditions there on average days of market, 32 days shorter than this time last year, and vendor discounting a little less as well, 3.2 versus 4.5 for the same period last year as well. We've talked a bit today around rents, and you'll see here for houses, 6.7% growth for houses so far to September, and 9.8% for units, just reflecting the strength that and key demand, given record low levels of vacancies that exists, again, also in the Adelaide market. To bring this in a similar way to life, here's a snapshot. Again, the deeper the blue, the more price growth in that particular location, which not much. Got to squint pretty heavily to see that little bit of pink that's there as well. So, but not much across the entire city region. And then if you look at this through the tabular format of the 4 SA4 regions in Adelaide, you'll see it's the Central and Hills district that's experienced the strongest growth for both the month and the quarter, and but still growth evident right across all parts, all SA4 regions. And on the right, some remarks around rental price growth, selling times, and selling activity more broadly. On selling activity, this slide, similar to Perth, just gives you that sense as to what's transpired year on year, and the trends and themes that you might be seeing in the market. If we go to regional SA, the dwelling values eased a little in September, but have shown growth for the quarter. This is a market that's continuing to reach record levels record levels of growth, still showing growth more broadly. So that's reflect a key strength there, up 13.2% in regional SA from April 22's low point, the last low point for the inflection point before the growth cycle kicked off. And again, you'll see the activity from selling days and selling activity more broadly across the regional parts of SA. Commercial in Adelaide, some of the same themes. You'll see industrial continues to be strongly sought after, some moderate increase in demand there, which you see also reflects in rent levels as well. Some further completions in the retail space, some stabilisation of rents at a summary level there, and office, with new completions either just occurring or about to occur over the next few months. We'll all be looking for what implications that are on some of those secondary buildings and the backfill that will go into some of those, recognising that that's one of the challenges to ensure when new supply comes to the market that the impacts on vacancies and the like. So still some stabilisation as that new supply comes to market here in Adelaide. If we go north to Darwin, this is a market that again was a little later to start its growth phase, commencing that in May of this year. The market's now overall 2.2% higher than it was in May, reflecting just a 0.1% growth in the month of September and 1.3% over the quarter. Listings there are down, total listings that is, are down 5.1% on the same time last year, and that's 3.3% lower over the 5-year average. New listings are significantly down 7.5% on last year, but just a little up, just 6.2% up on a 5-year average. So some different patterns at play here in Darwin, and that's resulted in sales activity also moderating off that record year, down 7.2% for the 12 months. And you'll see bottom of the screen here the implications and the key drivers there. Dwellings, which is houses and units, bottom left. Houses, which has been the area of softer conditions, and units as well, which have been performing more strongly. That's meant that average days on markets have lengthened just a little by 7 to 59 days. Vendor discounting has increased a little, up by 1.4% to 5.7%. So that's the difference between the list price and the final sale price. And you'll see there a more measured rate of annual growth in rents, with houses up 2.1% and units up 4% in that market. A little bit different to see the visual, but here it is nonetheless for Darwin, reflecting what's been occurring to mirror the series. And our final slide before I throw back to John to help us to take some questions, looking at regional Northern Territory. You see there the two regions, price growth, or two regions of Northern Territory, Darwin and the Northern Territory Outback region, which price growth for the month and quarter for Outback. And you'll see some remarks there on sales activity, selling days, and rental value occurring across those respective markets as well. So with that, John, I'll throw back to you and invite others that might have questions for Gareth and myself.
Great. Look, thank you, Mark, and to Gareth. Both very comprehensive insights about our local markets. I'm actually not surprised there's limited questions in the field at the moment, but what I'd like to do is now open the session up for questions from the audience. So feel free to send that in via the Q&A function at the bottom of your Zoom at the moment. Whilst people are thinking on those things, I might actually start with my observation about despite the world events and economic factors, my clients seem very optimistic about local conditions. In fact, Mark, your slides about the snapshots of Perth and Adelaide, green across the board, it makes me feel good being in Perth. And Darwin seemed to be experiencing a couple of pressures around listings. What I'd like to get from probably both of you, and starting with you, Mark, is what would you say to those who might be starting to feel a little bit overwhelmed about everything going on at the moment?
Yeah, look, it's an interesting situation, and it's not unique, I guess, for those in SA or WA. You know, if you're tracking East Coast media and national media, then you can think you're living in a different country in some senses. Local conditions, reflect strong growth for labour. You know, you can't get labour because there's no one to house them. It's this vicious cycle that's becomes quite challenging, and that's hard to reconcile with some of the wider messages around challenging landings. Notwithstanding, what's common to all of us is higher mortgage repayments, some of the same pressures. So that's obviously a challenge more broadly, right across the economy, notwithstanding a local factor that might be still in, keen demand for staff to fill vacancies, and then having the challenge of where to house them more broadly. And then I guess more broadly, I think whilst as a bank and as a banking industry, we continue to check in with those that we might see evidencing some signs of stress and the like. There's certainly lots of options available for anyone, any across the customer base, whether it is anyone experiencing challenging conditions. There's a whole team through our NAB Assist world available to support those to regroup and to design a approach forward as well, John. So some senses it could be living in two spheres. Another sense might be more practical help, John, but I'm not sure that fully covers your question, but happy to go further if that's helpful.
Oh no, thank you, Mark. I'm just interested in the sentiment, and to you, Gareth, from the the economic standpoint and the optimism, more broadly from your perspective, what's your thoughts around where people are feeling a little bit overwhelmed at the moment? What's the key things to focus in on? And sorry, Gareth, we got you on mute there.
Sorry, thanks, John. Yeah, look, we just keep getting more and more shocks, don't we, that we don't expect globally. I think, it's easy to get a negative headline as an economist, and there's certainly negative headlines sort of around, but I think it is important to remain a bit optimistic. I think the first thing I'd remind everyone is, rates have gone up very sharply, but policymakers don't operate in a vacuum, right? They're not going to hike us into a recession blindly. What they're trying to do is bring inflation back so that, effectively trade-offs down the line are not as bad, right? And low inflation is better for the economy and will ensure and maintain better labour market outcomes. So I think there's quite a few things to be optimistic about. I think the labour market has stayed quite strong and resilient, and there's quite a lot of opportunities there, and we don't expect to deteriorate that strongly. Australia is a good stable place to live as well, so it's another reason to kind of stay pretty optimistic. It's a time to be cautious for sure in a few ways and get the right advice for things, but we will go through this adjustment and hopefully kind of return to a sort of more normal sort of economic settings kind of in the next couple of years as these big or just huge COVID factors kind of fade out.
Great. Thank you so much, Gareth. Look, I've had a question come in from the audience online, so thank you for this one. So I'll read it out. Perth prices especially have been mostly driven by tight supply and increased migration. What needs to happen over the next few years to normalise this, especially the tight supply, as this is not sustainable in the medium or long term? So thank you for that question. I might throw it to Mark on that one.
Yeah, I'm very happy to take that. It's one of the key policy responses. I don't think there's one silver bullet. We certainly need to address availability of land supply or ready land to develop, particularly in a Perth and Adelaide context. Not Adelaide a little bit more accustomed to apartment or unit style living. Perth, that's not as much of the solution. I wouldn't have thought yet. People do like their land and properties. So I think availability of that in the first instance. So that's planning. That's back to labour as well to actually bring that to life. I think there's a number of other policy responses that have been talked about by federal government and even by local state governments as well to foster and to accelerate that, whether that's planning control reforms, whether that's other incentives to bring things to market more quickly and to accelerate that. But I don't think it's a 3-month or 6-month solution. This is a 3-year type solution at best. So I don't really have the silver bullet that's going to solve it for next year, John. Is my honest answer, and I'm not sure REIWA or Property Council or others would even have. Everyone's got lots of ideas, but I think it's a collection of all of those that we need to be addressing. And it's good to see Council of governments across the country now leaning into this as a key area. But if we're going to continue to increase our population and continue to meet the demands of both Adelaide and Perth and even Darwin, with all the infrastructure, with all the opportunities that are in each of those locations, then housing supply is one of the key critical enablers of that.
Thank you, Mark. And Gareth, did you have any thoughts around the supply aspect from your perspective?
No, I mean, Mark sort of nailed it. I don't think there's one silver bullet. It's not unique to Perth in a way. I mean, different sort of cities obviously have different geographies that enable maybe some slightly different solutions, but, kind of it is a bit of a local / state sort of policy problem, if not a national problem as well. I think ultimately migration is good and we need that, but it is quite important to have the housing supply. I think we sort of discussed this before, but reform on taxes is one sort of thing. It's not the silver bullet. You just need more supply, right? Zoning, the talk about NIMBYism as well. So I think, we need a multi-pronged sort of approach. Obviously, you can't turn the tap on and supply in 3 to 6 months. So there is an adjustment, and housing will cost us more in the short term. But like Mark said, it's encouraging that there is, some increasing focus on that at least.
Thank you, Gareth. And just a reminder, we do have a little bit more time for questions. If you would like to pop something in the Q&A function, please do. And also a reminder, at the end of the session, we will be issuing a survey. So we'd love to get your feedback about the insights you've received today. Gareth, this one's probably more of a high-level question around what are the risks and the recent resurgence in the oil price for inflation? Likewise, do you make anything of the recent depreciation in the exchange rate? So two-pronged there.
Yeah, look, I think a good question. Oil's been a bit volatile in the last couple of days, but it's certainly resurged over the last couple of months. Again, just one of those shocks that you can't really predict. And, we've certainly seen the impact through petrol prices. I think the real worry for us is, there's certainly a cost of living impact. The worry from the bigger picture is, does it become sort of more ingrained and feed back in the second round effects, so kind of transport costs increase, and then we see other prices and products rise. The good news is we probably haven't seen too much evidence of that yet, something we watch pretty closely. Likewise, I think, by definition, the exchange rate is a risk. We know that it typically takes a little bit longer for that kind of depreciation to pass through to prices. At the moment, there's obviously a lot going on in prices as it is. So kind of depends what firms do to margins in a period where, households are possibly adjusting and pulling back a little bit. But maybe offsetting both of those a little bit is that global goods inflation itself is easing, and if not falling in some areas, and some of the other commodities have kind of leveled off or pulled back a little bit as well. So, certainly two risks to the upside maybe over time, but there are certainly some other offsetting sort of factors at the moment as well.
Wonderful. Thank you, Gareth. Look, I'm mindful of time as well. We're coming to the end of our session. So thank you for those that did contribute to the questions. And I trust that everyone received some really good insights about what's happening in our local markets here. I'd like to thank both Gareth and Mark for sharing their insights. And if you would like some more information about anything from today's session, please contact your NAB business banker. Again, I just want to remind that we will be issuing a survey after the session. We'd love to get your feedback. So with that, I'll call a close to today's session. So enjoy the rest of your day. Thank you.